Well, as I expect something which will be the largest recession since the 1920s, 1930s, I think, it will appear everywhere. We're going to see a huge FOMO develop. We're going to see the S&P and we're going to see crypto and what else develop and skyrocket. And I'm long everything right now, every risk asset right now, because I think gold will do bad in the beginning of a crisis like it did in 2008. I think we're going to see oil going below $10.
CBDC, central bank digital currencies. Interesting good or interesting bad?
I think it's interesting, good. I would expect, and I think when you look at some of the companies, Cameco, I think is one of them, and as I see technically that there'll be new lows coming in some of those stocks. But uranium itself,
All right, Henrik. Last I heard you on an interview, you were talking about one last rally. By the way, if you want to say it like sort of a blow off top is what you call it, that you expect will take the S&P over 6,000 within less than 6 months, which you said would be based on the market's hopes or belief, really, that the Fed has manufactured a soft landing, while in reality, it hasn't, and that blow off top will end badly. You said because all of the indicators that you're looking at are pointing towards a recession and a market crash that, well, if we want to be sensationalist about it, would be worse than the 1929 crash. And you expect that in the latter part of the year, basically. And I try to consume as much information on this as I can possibly can to wrap my head around it. And I still am failing. But just so someone else who I often speak to, Joseph Wong, he's a Fed guy 12, I believe, on Twitter. He's been doing the rounds asking, um, or basically saying something along the lines of how can we have a recession when there's still $2 trillion of helicopter money being dropped in the economy? So yeah, that's pretty much where I want to kick it off. How can we have a recession with all that free money going around?
okay, fair enough. First of all, I want to say that I think I've said that the recession we're going to have and the economic downturn will be worse anything we've seen since 1930s. So I think it's
Good.
just a since or more than, but it's fine. I mean,
It
it's
works
just
for
I'm
the
trying to
YouTube
correct it every
algorithm.
time because it's something that gets stuck, but it's okay. But in terms of the recession, why we will have a recession? Well, I think people are putting the carriage in front of the horse here because liquidity is fine, but liquidity needs to be used in order to make the real economy run. So when you drop liquidity on something, you want to make people incentivize them to spend. You don't want them to save. You don't want them to put them into investments. You want them to save. Sorry, to spend them. Buy another car, buy another kitchen or whatever it is, buy another couch, something. And we have to think of what we have just seen people going through over the last couple of years here. We have seen them experiencing the largest interest spike we've seen ever, at least last many years, 100 years. And when you're then, let's say if I'm right that we're going to see some unemployment coming and it's starting to develop soon. I know the numbers today do not suggest that, but this is based on my model. But if I'm right on that, and you start to see some kind of decline in the economic activity, which you do around the world here, we can look into China, we can look to Europe and elsewhere. Well, then you will see that people will need to start spending at a time if they get unemployed, but also when they've just felt a huge hike in the interest payments. And that's just not how the people, consumers work. If they have seen a spike in interest payments, they will be less likely to spend the money. So it's correct with liquidity coming in, and that's the financial model of the financial understanding. We just need to pour liquidity on it, then we'll never have a crisis again.
Hmm.
But guess what? When we have inflation, you have interest rate spikes. That is actually affecting the buying behavior of the consumer, and they may be sitting and thinking, well, you know what? I may not be taking that second loan now to buy, or I may not need that car right now, or whatever it is. And we just had one, just a few years ago. You have to remember every time we do this, every time we stimulate the economy, you do not create extra demand. You borrow demand from the future. So people, I mean, they can only use as many. You cannot have a new car every day. I mean, you need to have it for a couple of years or whatever it is. So you will see that, of course, you can drive the economy with liquidity to a certain point, but then you cannot do it any longer. And I think what people are thinking here is that, oh, we'll just throw a lot of liquidity on this system, this problem here, and then it'll go away. Well, we have to remember that, the consumer is what drives the economy, and I do not see them drive this. And if you ask me why would we see the downturn that will actually make the consumers less willing to spend, well, this is based on the leading indicators and the business cycle model that I have. I have a signal there which every time for 100 years have never delivered a fake signal.
Mm.
That means no extra, signals, or no recessions that did not deliver a signal every time, even the Corona crisis. Every time we've seen a signal there, and we have that in place. We have the yield inversion in place, which is also a signal. People then say, "Yeah, but that was last year, and now we kind of forgotten about it." Well, it's very much alive. Because what people do not realize is actually from the moment when we have the spike to the downside in the yield inversion till the time the recession starts, we often see more than a year pass on before we see the recession. And that spike lower was in June of 23.
Hmm.
So people are way too fast. And also, I have to say that if you look at the rest of the world, Europe does not look too good. Germany doesn't look good, and China doesn't look good. So we need also to get away from this that the whole world is just the US. It's not. And then there's a lot of, huge countries and economies out there. So I'll say to the ones that say, oh, liquidity will save it, or AI will save it, or whatever it is, these kind of things, is disregarding completely the business cycle and what are the real drivers of the economy, and that's the consumers.
Hmm. That's something I want to talk about. I want to touch upon maybe later on in the conversation some of the other countries, because Japan keeps on making new all-time highs, and there's other interesting parts of the globe to talk about. But to sort of go back to the first thing that you said, I recently interviewed Danielle DiMartino Booth as well, who agrees with a lot of what you're saying there. But under that video, somebody commented something along the lines of, "This recession is like Bigfoot. You hear about it all the time, but you never see it." And it's kind of funny because it's been true up until now. When I go out and everyone is consuming as if there will never be a recession again. People are driving new cars, maybe working multiple jobs, making even more money, going on vacations all around me, right? And that makes me wonder. I understand that it's a trivial data point only of one person, but it makes me wonder, where will this recession be the most apparent, if that makes sense?
Well, as I expect something which will be the largest recession since the 1920s, 1930s, I think, it'll apparent everywhere. And what
Hmm.
we have to consider, if we think of it in an economic, way, in the Keynesian way. So let's think about what happened. We had the Corona crisis, and we had a pullback in demand, in the aggregate demand. What we saw was that the Fed and the administrations around the world went out and stimulated the economy. They created a lot of extra demand.
Hmm.
Actually, the largest stimulus we have ever seen. It was bigger in real money than what we saw after the Second World War, when we had, the Marshall Plan coming in and needing to rebuild the whole of Europe. This was what they put into the global economy at that time. This was in 2020. And they did that at a moment where the supply chains were breaking down because of Corona, because people could not, could not go to work. So what you do there is that you stimulate an economy that is kind of shut down. Of course, you get, first of all, inflation, and you get this kind of huge demand coming in, and no everybody is doing well because everybody who has anything to sell will be sold at that point. What happens next? Every producer, manufacturers around the world has then been building their capacities. This is the reason we see that if you look at the inventories of retailers and others, you will see that it's actually exploded. It's much higher than it were previously, and it's much higher than the trend we have had. So they built capacity. They hired an extra people. Everybody was screaming for people at that point, and we've seen huge wage increases also for certain types of people, and there are certain goods you couldn't buy almost. This is where you get a lot of companies saying, "Oh, we do fantastically well. We need to build the capacity." So now what happens next? After then, the stimulus starts to fade away because it's not there, for eternity. It's there, it's getting pushed in, and people will spend the money. Well, then you'll see that demand actually starts to come down again. And that extra capacity, all the companies out there have been building, and the extra people they've been hiring in, they will start to lay off again because the demand is falling back to a normal level. And that is the process we're about to see. That's also why you see inflation is actually coming down rather fast. So when people are saying, where will it be felt and why will we see it? Well, because it's in the dynamic, it's in the cycles that we see. We've seen everywhere that we have this surplus capacity that needs to come down to a normal level. We've seen also, if you look at things like now we talked about liquidity. If you talk about the M2 and the rate of change of that, we've seen 3 times over the last 100 years, the rate of change on the M2 go in negative, 3 times.
Sure.
And the 2 times before that, we had a year-on-year inflation of -10 and a -15%. And the third time we saw it was last year. And I expect inflation to drop really fast. And that's what we see. If we look at Trueflation, they are estimating it at around 1.4%, 4% or something like that. I just looked at it. And that is very, very low. I know that's not the CPI numbers that we see right now. They're coming out. So we have to understand that the economy is a big, it's a Swiss clock. It works like, there are certain things that will happen and then it takes time. And you talked about this, that it will, it's something everybody talks about, but we haven't seen it. Well, because people are not, they do not have patience. They say, okay, if it doesn't happen tomorrow or the day after, it doesn't happen. And that's where they will be mistaken. As I said again, with the yield inversion, the last 4 yield inversions you've seen more than a year from the bottom of it till the start of the recession. This time around, we're only six months away from it. So I'm saying, people are way too fast in just neglecting that. And if you look around the world, again, I'll say that things are really not looking good. Where will we see it? Well, it can, start in China. It can start in Europe. I think actually we will see that. It'll happen, we're close to a recession in Europe at this point. I mean, Germany is not doing fantastically well. So it's, again, I think people are overseeing or forgetting about all these normal things that we've seen before, and then saying, oh yeah, it's not happening this time around. And I'm old enough to remember actually also the last time we had a real recession, like before the financial crisis and also before the 2001 crisis. Things were actually dragging out before the expected crisis actually set in. And that's what we see again.
Well, and then again, it depends on where in the world you're looking at it, because while I read you on your take there, I'm also looking at some other data that's been dropping. For example, the Atlanta Fed is now showing a forecast of real GDP growth for Q1 of 4.2%. So essentially, you're saying that we'd flip from that to, well, we got to flip to that from that to negative in Q2 and then negative in Q3 to have 2 consecutive quarters of negative GDP growth to have that recession. And to me, that sounds like quite the aggressive move, especially considering, like as you mentioned, where the jobs market is and where federal bankruptcies are, which by the way are declining. So that thesis sounds almost like a demand shock or a policy mistake type of move that would have to happen. Do you think it's going to be
That
something
happened
like
already.
Okay, what is that? What's happening?
The policy error that happened already. I mean, supplying, so first of all, to stimulate into a supply crisis is a major error. But the thing is, with the economy, like with a super tanker, you may hit it, but it doesn't sink immediately. Titanic doesn't sink immediately. When you hit it with something, it happens later on. And that's what you will see also with the economy this time around. You will see that it slowly starts to deteriorate. You have the housing market, which is really not doing well. And you have seen the interest spike that we have seen for personal interest payments that has been shooting up faster than we have seen ever and higher than we have seen for the last many, many years. You've seen housing affordability, which is under the floor. It's like what it was in the 1980s. So all of these things are slowly, seeping into the real economy through the consumers. You also see it on luxury goods, actually starting to also have less of demand. That's where people will lay off the demand of the consumption first. So I know people will not accept and say, yeah, but that's nice with the theories and all that. And nothing is for certain in this life. Of course not. But what I'm saying is that we have 10 indicators and 9 of them is flashing recession and is flashing recession within as I think I said June could be a top in the stock market, maybe earlier, but also I could also see it in June. But I think second half of 2024 will be very bad and 25 will also be bad. So I think people are too fast and just pointing to certain things, and when it comes to the real growth on the GDP, What you've seen is that you've seen a normal business cycle. Actually, now I can't show the chart, but you'll actually see that it actually follows a very nice cycle. We have seen that rollover, but what we also need to remember is that the real GDP is actually a coincident indicator. That is the indicator that tells us where we are right now. But the leading indicators, the ones that we can look from the conference board, are actually in red and have been so for 20 months in red and declining, which was what we saw up to the financial crisis as well.
Hmm.
And this is also what is my model is based on. This we do some of the calculations on that. So I'll just say that yeah, I understand it. And again, also I forecasted this a year ago when I said we're going to have a blow off top and reach above 6,000 on the S&P and what else. I said before we get to the point where the recession sets in, everybody will get bullish and everybody will believe in the soft landing. And this is where we are, and this is what we see right now. And again, they will disregard everything we have seen before and say, yeah, but this time around, and this time is different because, and then you have liquidity, the Fed will not allow it, the presidential cycle, and what else do we hear? But looking at macro, it's quite clear. We're going to have a recession, and the recession will be very, very bad. And it's going to be because the consumers are getting hit by interest rates. They're getting hit on their consumption, the ability to consume. That means that work, the employment will start to roll over. I know, again, the numbers today were really, really strong, but we have seen that before as well. And also, if you look at it technically, you look at the interest rates, you look at the market yields, the 2-year, you see that they, in a technical setup, you could see a plunge coming to them. And I cannot see how that can happen unless we're going to see a recession. Also, why would inflation fall as much as it does? You will not see that in an economy that was doing well. Of course, there is a time where we will all feel this is good and nice, and that's what I call the Goldilocks zone. If you follow my on Twitter, that's where we're in that right now. That's where people are starting to think it's safe to get back in the water. It's not too hot, it's not too cold. We can get back in, and we can start investing again. That's what we see, and that's why we're going to see a huge FOMO develop. We're going to see the S&P, and we're going to see crypto and what else develop and skyrocket. And I'm long everything right now, every risk asset right now, because we have not reached the blow off top by far. I mean, there's so much more in this market before we reach that level.
Well, but this time is different because when the housing affordability was as bad in the 80s, at least that was coupled with the founding of Iron Maiden, Metallica, and Motorhead. And then these days we get mumble rap and unaffordable housing, so it's even worse. But what else I've been thinking that has been completely changed though since the 80s, obviously, but since COVID really is sort of the jobs market. I mean, forgive my trivial data points here. Again, I'm looking from my own sort of point of view, but people around me who, I never thought could work from home or online or something like that now have like 3 jobs, 2 of which they do sort of over the weekend, producing as good of an outcome over, say, 12 hours as someone would in maybe even in 2008 would have produced over like a 38-hour or 45-hour work week. Again, technology, working from home, and so on and so forth, which because of which they have higher discretionary income, basically. So, yeah, I don't know if I have a question here, but I feel like you have an opinion on that.
Yeah, but I get what you're saying, and this is what everybody does, and say, okay, but how can you say recession if I can point to 1 or 2 data points which tells you the opposite?
Hmm.
And I know this guy, and I know these 5 guys, and and everybody's and somebody and blah blah blah. I mean, that's what we hear often, and I don't want to be condescending here or anything, but that's what I hear all the time. What I'm saying here is that we have very, very clear signals that in the normal business cycle will tell us that we're heading towards a recession. And we are seeing it, the deterioration beginning in Europe. We're seeing it in China, where we see the bubble is actually bursting in terms of, the housing bubble and what else. And we are trying, they will try, of course, to keep it up with liquidity again. And all these things, we've seen it before. And then again, and there I got enough, gray hairs to say that I'm old enough to remember also before the 2001 crisis. We also said, well, this is a new economy. We have to understand these are new types of companies. Before 2007, yeah, but the Fed has our back. Will not happen this time around. And now we just see and hear it again. And I'm not gonna fall for it. I didn't fall for it in the financial crisis, but I definitely do not want to fall for it. 3 times if I can help it. And we just see the same thing. So I don't take this as much of an argument. I understand what you're saying, and I can see that there are so many positive things out there, and artificial intelligence, and that will help us become more
Hmm.
productive and all that. But the thing is, Titanic hit the iceberg. The moment when inflation went above 5%, 6%, and we saw interest rates spike up. We've seen people getting hit by that, and they do it right now as we speak. They pay a lot in interest payments, and these are very very high compared to what we've seen the last 30, 20 or 30 years. And this is what is harming them right now. This will affect their ability to consume, which will then, and this is a much bigger thing. It's a much bigger cycle. We are 8 billion people on this planet here. And there may be a 20,000 or 100,000 or 1 million or something that can do positive things. But in the bigger cycle, people are struggling from what we see. And that is what will slowly deteriorate the thousand cuts. The death of the thousand cuts is what we're going to see, just like what we see always, and it's going to hurt the consumer. And yes, the Fed will jump in and try to prevent that, but it's will always be already be too late at that point. That's what I'm saying. The policy error has been made already. I mean, the huge stimulus that they did, and now when they start to hike rates as they did, which is also a mistake because they needed to see this in a dynamic model where they actually understand that the economy will start to heal itself. When you have inflation, it can heal itself. It'll bring inflation down again. But they thought they had to be as hawkish as they did, and they have been, causing and making this much, much worse. And I hope, 2, 3 years down the road, they will actually be able to see both the first one, which is that the COVID stimulus was a mistake, and also that they were so hawkish as they've been.
Hmm. My it was my wife's birthday a couple of days ago, and she made me see the Titanic for some reason. And we were watching it. I got bored somewhere halfway, and that's like a 3 hour movie, 3.5 hours. I was like, how long does this ship take to sink? And so I looked it up. It sank in about like 160 minutes, 180 minutes. So like almost about the length of the film. But it took a while for those boats to be deployed. What do you call them? The dinghy type of
Lifeboats.
thing. The lifeboats for them
Yeah,
to be
yeah.
deployed. It took like an hour or something. So like 1/3 in the way. And I like that metaphor about the Titanic because it's making me think, what are the lifeboats for the economy in this case? And isn't it flipping from QT to QE? Like, wouldn't that be lifeboats?
Yeah, but again, you're jumping to the conclusion there that liquidity will save the day. It's
Hmm.
because we've been
True.
living in that world for such a long time that you can throw liquidity on a demand problem, and then people will take that liquidity in and start spending. And you can do that for only so long. But the thing I think, and now you're talking about what is new this time around, I think this is what is new. I think that you actually shocked the consumer that, oh, you can actually have inflation. And that means that they will be more cautious and start spending that money, even if you're pour money at them or make their loans much more less expensive and so on. They will be more cautious. And I also think that you are before you start to see that, because that's back to my business cycle model. You'll actually see the interest rates will come down later than we actually see the labor market starting to deteriorate. So the interest rates will come down very strongly, and the market yields will come down strongly. But you will always already have a lot of unemployment there at that point, and that is what I think we'll see as the next thing. I think the next thing that's what I'm keeping a very very close eye on, is that you have all the leading indicators are now telling us, like during the financial crisis, this is not good, guys. There's something bad, and we just need to see the labor market. And this has to do with the large companies and all companies, all organizations around the world will start to lay people off because they do not see the demand coming back, which they have been expected, which they have been building up to during or after the Corona stimulus. So this is about what how things are interacting, and how it all works. And like as I said, it's like a Swiss clock. Um, you asked this about the lifeboats. I mean, at this point here, it's not just about liquidity. It will be about, removing debt, because I think what people would be afraid of at one point will be that I don't want to start spending money again because I owe this much money, and I'm this much in debt. And I remember in 22, 23 when we had the high interest rate. So, I don't want to spend it on this, right, and do another, buy another car or whatever it could be. Again, it's just an example. Because they are simply getting frightened by what they saw, and this will keep spending back. as I see it. That's why I think, liquidity, that's also why you've seen, diminishing returns on liquidity. We also have to acknowledge that every time they throw a trillion on it, we've seen less growth coming out of that. That is because of some of these effects are taking hold. And I think that's the change we have seen, we will see with the inflation coming in, because we haven't seen inflation for the last 15, 20 years almost. And
Mm.
then all of a sudden, boom, it was there. So even though it comes down, even though interest rates come down again, I think it has, shocked a lot of people, which will delay the effect of the QE. But just to make it clear, I think there's no doubt that they will try to do it again. I mean, the free lunch that they had in 2008, they can just throw money at it, and let's give Bernanke a Nobel's Prize, but based on the fact that he reinvented money printing. Well, I mean, stupidity. Sorry, my French, but it was. But everybody knows that when you do that, you will actually artificially pump up values in certain things. And you have also this time around we have speculation. Crypto. That's one big speculation. I mean, do you see anything bigger than this, where start to speculate whether the one shit coin is better than the other? That's speculation, and it'll grow bigger. If I'm right, we're going to see like a 5 trillion crypto market before we get to it.
Mm.
So you have again all the components of something that can blow up in a really bad way. You also have a lot of startup companies that never made money, but they needed funding all the time because money were free. Again, if they are starting to get bankrupt, this will be some of the things that can get the snowball to start rolling.
Mm. They're preaching to the choir here, because I mostly invest in non-revenue generating exploration companies that go look for hidden treasures in the ground and almost never find them. So I know the pains. But you make an interesting point about Bernanke. And we don't have him at the helm right now. We have Powell, who I'm thinking about, he's oftentimes described as sort of a libertarian, an old school Republican, if you will, libertarian type of thing. And what I'm thinking about is, does he really care as much about that as much as he care about what he's going to leave behind him? I mean, he's already on his way out, whether he's 1 foot out or not. It looks like he's closer to the end of his career as chair of the Fed than the beginning of his career. Let me put it that way. And so is he going to push whatever is best for the Fed, or whatever is best for himself to make a name, to sort of exit with a bang type of thing?
Oh, I'm not sure I'll be the best one to answer that question. I mean, there's probably people that will know him better than I do.
Mm.
And but what I see is that I honestly do not like the whole fuss about the Fed. I mean, I think it's become way too
Yeah.
ecstatic, euphoric on what the Fed can do. And if you really look at it, it's not the Fed who's driving. When it looks to the market or the rates, the Fed fund rates, it's just following what the 2 year is doing, basically 2 year market yields, U.S. Government bonds. And if you look at that and you look at their language and all this, it's become way too. It's become a show.
Yeah.
So whatever Bernanke or Powell or whatever thinks, what I'm looking at are the structures of the economy, and I look at the real business cycles. And there's one thing you can, for a short amount of time, with the amount of money that they pushed out after the Corona crisis, they can push up demand really short time, and that we've seen how short they can do it. And even though it was as aggressive as it was, I mean, think about it. They did that in 2020, and now we are 24 here, and we are starting to see the cycle roll over already. So I think that the whole, what he will be leaving of what kind of legacy he'll be leaving or wants to be how people should be thinking about him. I don't know if that's what he thinks about, but I think that mistakes have been made from the Fed side, and I don't. It doesn't matter if it was Bernanke or Powell or whatever kind of political a standpoint they have. I think it's in the cards right now, and there's not much that can be doing. Back to you, or the lifeboat. What can be done at this point? They will need to get to a point where they will have to remove debt. That means that debt forgiveness, debt restructuring, and the likes. Because if things are getting going as I think they will, well, people will not start spending unless debt is lifted off their shoulders.
Mm, right. Hopefully we don't have to rely on those slabs of wood, because apparently even if there's place for 5 people on there, the women are not going to take us on there. But you were talking about removing debt, and that was interesting, because removing debt, you could easily, not easily, but you could remove debt through inflation, right? You can sort of let inflation eat away your debt. And the most indebted parties out there are governments, as you mentioned. So wouldn't it be logical to think about the organizing inflation, if you will, so that the debt is eaten away and organizing it through QE or whatever else it might be?
Inflation is not good for the consumer.
Yeah.
So, and if you want to start, so the problem is here. You have a situation, if I'm right, you'll get to a situation where deflation will become a problem, and they will throw
Mm.
QE money on it again. Let's look at it like that. They definitely will, and they will get a bounce in the economy, and everybody will think it will happen. But eventually, when the next downturn, and I think that will not be long after, I see there will come a second phase to this crisis. The first will be deflationary, then you will have something that will become stagflationary because of the reason I said. They will throw money at it, but the real economy will not turn as fast, and that's why you'll actually see that the money will start chasing commodities, and I think that's when the real commodity bull will actually start or begin. I think that what was your question again? Sorry, I think I just lost my thread here.
When they try to organize inflation or whatever you
Oh
want
yeah,
to put it, yeah.
yeah. So I don't think they will organize inflation because, as I said, that will harm the consumer, and they don't want that. They will want actually quite the opposite. so so they will need to get people to start spending again without getting inflation up, because that probably will become the problem at some point. Stagflation, you will see that they need to do something which is more structural.
Mm.
This about throwing money on it. We have tried it over and over and over again, and it didn't go so well before the French Revolution. Actually, that's probably one of the reasons we had the French Revolution. And so I think this about trying to think up a new thing. Okay, we just got these free money, we can just start throwing it at the economy, and then we'll solve it, and we can organize inflation and things like that. At some point, people will react as consumers, and they will. I think they do now, and they will, when they do not spend, it's because they are over leveraged, they have too much debt, and they will try. The administration will need to relieve that in order to get the consumption up and running again.
Hmm. What if we pay a bunch of guys to break a bunch of windows and then we get the economy going that way? What I'm also thinking about is risks to the global supply chains, though, because that what we're talking about here is the demand side of the equation, right? Um, and you can have deflation when demand is lower than supply, basically. What if it's the other way around? What if supply drops quicker than the demand drops? Community opposition, labor shortages, weather, or even wars related type of shortages. Where does that come in your analysis?
Um, I First of all, I do a lot of technical analysis, which creates the narrative for me. So I don't, it will be a surprise to me to see that the supply of course, the supply will be shrinking now. But if there is a demand, there will always be a supply, because people want to make money.
Mm.
They will create the supply that is needed. So I don't think you will see a supply shock which will bring the economy down alone, unless we get another corona epidemic or pandemic, or something like that, because that's what happened the last time, of course, with that. But if we got a normal recession like what I think we will have, it will be driven by the demand side, and the supply side will then follow down, and that's why we get the negative spiral. So I don't see something. I cannot predict any pandemic coming out, but if that was the case, well, then you could have a supply side shock.
Mm.
um but that's not part of my analysis. My analysis will say, well, we got a normal business cycle, it's rolling over, and that means that consumption is coming down, and then GDP will come down. And unfortunately, we have been blowing this economy up to a level it's not sustainable through easy money. People are struggling right now, and a lot of things, a lot of speculation in crypto and so on, and all this will be one big package, so to speak. And when the shit hits the fan.
Mm. Something that I do look at, and you tell me if that's a good or a bad indicator, is gold, because it's typically forward looking as far as I understand it. So it goes up before an inflationary period because supposedly people are expecting inflation, and therefore they're loading up on gold to protect themselves against inflation. And that's what central banks did in 2023. That's sort of a thesis, if we will, that I've seen out there? Is that an indicator that you would look at as a forward-looking indicator?
No, because I think gold will do bad in the beginning of a crisis like it did in 2008. 2008 from March till to September, it dropped by 34%.
Mhm.
Silver dropped by 60%. And that's because when you have a real crisis and a banking crisis and a supply and dollar shortage that I also think we'll have liquidity crisis, you do not want to hold gold. Why would you want to hold gold? You need liquidity. So why the reason why people are buying gold often is because it's something you can hide under the bed or something like that. But you need it because you do that because you need liquidity. You need to be able, if you go to the that extreme situation, you do it because then I buy bread with it, or do something with it. It's not because they expect to become rich. It's something I can hide under my bed and then I'll be fine. What happens in the real world also is that when the crisis starts to develop and you get a deflationary bust, you'll actually see that precious metals do not do well. People do not really think about it, but you just need to go back to the former crisis and say every time you had the deflationary, of course it happens after the crisis. The moment when the Fed steps back in September and you see QE coming out, whoa, then it goes. And that's when you had the bottom in gold. But that's not where we are right now. We are right now, we are in a situation where the Fed is doing tightening, and you have also a situation where, if I'm right, demand is coming down, and you have an economy that is heading towards a recession. So why would I hold gold? I would not. And I also, if I look through inflation and I even look at CPI numbers, inflation is coming down really quickly. That is what it does through a recessionary phase. As I said, also if you look at the M2 rate of change, you see that 3 times since 1920s we have had a negative year-on-year rate of change on the M2, which means that the money supply has been coming down, which is not a good thing also for inflation. So everybody's talking about gold right now. Seems to think that they have some kind of reason or some kind of the recession is coming, hence you need to hold gold. But that's a very, very not that's not the full picture at least. What
Hmm.
I see right now is that I think potentially we can see just a new high on gold coming up to 2200 or something like that. But I still see a very, very big drop coming into a recession, and I see gold also dropping to 1250 around that level.
12, that'd be a big drop. How long do you think that drop is going to go on for? Is this sort of type of a 2008 scenario or 2020? And what I mean there is that in 2008 took it about a year to correct to that previous price level. 2020 took it a month. So how quickly do you think it recovers?
2020 was different kind of species. What I see is that we have a situation like in 2000 and after 2008 or in 2008 where you actually saw you saw recessions break setting in December of 2007, and then you started to see that the dollar started to strengthen into 2008, and you saw gold actually declining from March of 2008 until September of 2008, so 6 months. And I think that's what you can see. Look into here as well. I think it'll be very, very steep. I think it'll be because I think the deflationary forces that we're going to see, and this comes from some of my technical models from the yields that I'm looking at, is going to be very, very strong this time and stronger than what we saw during the financial crisis. That means that a lot of people will be needing liquidity. And I also see Dixie rising to around 120. Not again, let me just make very clear, people understand this, not directly from this point. I think Dixie is going to drop into the blow off top to around 90. And then I think we're going to see around 120 into the crisis. And that will be a very, very quick rise. I think some of what we have set in motion in terms of with the whole thing after the Corona crisis is going to create some kind of whiplash in a lot of asset classes. We haven't really seen it yet in some of them, but it's coming, and that's why into the recession I would not be holding gold. Coming out of it, or at the moment when you see the Fed comes back in and they potentially pour money on it again, gold will be fantastic. Gold miners, silver, even silver.
Mm.
And one of the reasons why I also say gold is not the place to hold right now in a real gold bull market, you will see that the gold miners and silver would outperform gold.
Mhm.
That's not what you've seen. You've seen silver and gold miners are way, way below what they were in 2011, 2012. gold is up around the highs of that time, but that is the odd man out right now. Also, if you look at platinum or palladium or anything like that, you see the same picture. So
Mm.
gold is the one standing out, and in the technical setup, you actually see there is negative divergence on this on the rally we have had. I still say I think we can reach 2200, but I will definitely not be holding gold at this point.
Right. For how long would that be? Like, how long would you?
Oh yeah, that was yeah, but I think it'll be 2008 setup. It'll be my models point to a potential dollar top in late 24.
Mm.
That means that's probably the timeline where we'll see gold decline. But again, remember, it's from the moment we see the potential top in around 2200 if we get there. It's not necessarily a thing where we're going to get there, but I think the dollar decline is starting to decline towards 90 would create some tailwind to gold. But as you also said, it will be forward looking in terms of inflation and deflate and if we get a deflation, as I think, and we see inflation coming down as strong as it's done over the last half year now, um, look to Trueflation. They do really good and decompose their numbers into understandable bits. Well, then you'll see that inflation is actually coming down really rapidly, and I think it'll be much worse. And you don't want to hold gold there.
Hmm. But so essentially, that's a 50% rounding up, but a 50% drop in gold, um, within
40 around 40, 45. Yeah, they're around.
yeah.
Yes.
So with it, and this would be like a 12-month type of thing, and then another 12 months later, you'd expect well, if it were to go back to its all-time high, that would be like a 100% spike. So a 40 to 50% drop into a 100% spike within like 24 months.
I'll say, with the moment when we see the Fed coming back in, and if they create a stagflation, as I think so, first when they meet the deflationary bust, get back in, pour money on it, and the economy doesn't react, but the money starts to circulate, we get inflation. Well, then I think gold miners, silver will be a fantastic investment. But holding it into a recessionary, deflationary bust will not be the right thing to do. Yeah, if you have deep pockets and you don't need to get any, but that, why not buy it 40% cheaper at some point? I would not be holding it there. And technically, it doesn't look good at this point. I don't think it looks good.
Hmm. Do you also follow something like the gold to copper ratio? Because I'm looking at copper, year over year, it's down about 6%. Gold is up 10% year over year, and so that's oftentimes said to be an indicator of sorts. Is that something you follow?
No, I don't. Actually, I don't. No.
Hmm. What do you then make of sort of the more economically sensitive metals, gold? No, not metals. I was talking about. I'm reading as I'm talking, and that's not a good combination.
Sure.
But of the of the economically sensitive commodities, so copper and oil, where Dr. Copper, yada yada yada, would
Mhm.
would they recover as quickly as gold would recover? Do they go in tandem, or they go the opposite direction?
Let me first say how I think we're gonna, what we're gonna see on oil, and I think I said before in 2019 I think we're gonna see oil going below $10. I got tweets on that. Nobody believed me. We were at $70 at that point. I think 70 or 80. I think we're gonna go below $10 again. Needless to say, that will not be a long-term bottom. It will be something we drop down to, we touch upon down on it, and will be a couple of months, and it'll be back, and it'll come back up again.
Hmm.
So I think everything we'll see into the deflationary bust will be reversed rather quickly, because that's what we get. That's what we get from the Fed. That's what they do. They can initiate, they can shock start the whole economy with that. So I think that is going to develop really well after that shock, right? So how fast it will be back up again? I think we're talking about a whole new cycle developing. So after if you look at the after there is the contractive waves, the long-term waves. If we look at that, there is the contractive winter. And what I think we will get to when we get past the entire crisis here, which will be the last one in the contractive winter, then things will start to develop in a very different way. And what we can compare this to will be 1950s, just after the Second World War. You had the cleanup of the monetary system through Bretton Woods and so on, which I think will also come during the stagflation here. But anyway, so I think you'll see a commodity boost or boom coming out of the deflationary bust, which can already begin in the crisis. Because what we're probably going to see is that as I said, the Fed coming in, and you will start to see money chasing these commodities as people and consumers will not start the spending will not start to come up as they want. So I think you'll see money chasing some of these commodities, and that's why we can get this deflationary period. And that's why obviously commodities, gold, silver, everything, copper will also be good at that point. But in copper also, I think Dr. Copper, I think there is a rally coming in that into with the next couple of months here. But then I think it's done also, and then I think it'll be a rather large drop in copper as well.
Hmm. But you don't think it's going to be sort of a 1929 scenario where it takes like a decade pretty much to recover. The recovery is going to happen quicker.
Yeah, because I think what they did back then was what would probably have been gotten better at, or the Fed has gotten better at, and the administration is actually to do the kind of stimulus that is needed, because we have this picture of where we do not want to end up, and we do not want to try to have the economy solve itself. And so I don't think it will take that long. But of course there will be some consequences of this around the world. There will be people that will lose a lot of money. You'll see a lot of the real estate also lose money in the beginning, and so on. So I don't think we'll see that, but the depth of the crisis, the speed of how we go down, will be something that we haven't seen for a long time. That's what I mean when I say since the 1930s. But no, we're not going to see another 15 years period or something like that, since the 29 until, was it start of end of after the end of the Second World War, of
Hmm.
20 years time. We're actually already in that period. That's what people do not understand. We are in that period. If you have to compare the periods, we are probably in the early 40s or something like that at this point here, and we need to see the last dip in the market there. So we cannot compare completely, but it's we have a couple of years ahead of us. It will be very, very difficult, and then I think things will be much better, because I think there will be a lot of cleanups. There will be a lot of debt restructuring. There will be a lot of maybe even a new if we see stagflation, they probably have to make sure that sound money gets back in. So we probably see a monetary kind of reform or something like that, monetary reset or whatever. So many things can happen over the next years. So these will be very volatile times, and I think it's about the whiplash. One way and the other way will be very, very difficult for people to navigate.
Hmm. And in the meantime, as far as I understand what you're telling me here, so you're going risk on completely. So it's well, tech, Nvidia, Bitcoin, whatever it might be. For me, that might be again the non-revenue generating exploration companies and stuff like that. And then after, when the recovery starts, that's when you go miners, gold, silver miners specifically. What about in the meantime? Like, are you going to be shorting the S&P, or are you doing something else? Like, are you hiding out somewhere?
Yeah, the dollar. I mean, there's plenty of opportunities in just hiding out on the dollar. I mean, if you have a deflationary bust, as I said, I think the Dixie is going to run to 120 from 90, which will be a fantastic ride. There will be some fantastic opportunities in various forex pairs. So I want to hide out in the dollar. That is the real currency of the world. That is what people will be needing, and the dollar will rally tremendously from that point. Again, remember, I'm seeing the dollar decline from around these levels here, maybe a little higher from where we are today, but around these levels. And then we should from the Dixie around 90, we should see the dollar moving up a lot. So that is where I want to be. And also U.S. Bonds, U.S. TLTs, and the likes could also be a place, because that's when inflation comes down, yields coming down, rates coming down, you want to be in U.S. bonds, and I think it's a steal at these prices today, honestly.
Hmm. Yeah, it'd be finally a relief to see bonds actually starting to go up. I know a bunch of
Hmm.
people who've been hurt on that, but
Yeah,
it,
yeah, absolutely.
I appreciate your data-based approach. Like you're following the business cycle, you have your whole thing. You're following the charts and the cycle. Like it all makes sense. Oftentimes, I have all sorts of people on here, and they will tell me, a 15% inflation or 50% hyperinflation type of thing. Don't get me wrong, they're great for headlines, and I get a bunch of views, so I'm happy
Mm.
with that. But when I ask them, where are you getting that data? What is that based on? There's not always a correct, a full answer on that. And so I appreciate
Mm.
that part of you. How does all that how do you where do black swan events basically come into that is what I'm trying to ask here. Um, Going back to those supply shocks, if you will, because you mentioned oil back to 10, but we have the whole thing in the Red Sea going on, and I have no idea how to, I can think about it if I follow everything day to day, but is this sort of a an automatic way to bake that into some kind of a model or something that you do?
No, I mean, when it comes to these things, I don't listen. I mean, it's because the media need something to write about or to send. I mean, if
Mm,
we get something in the Red Sea, well, of course, it could become a problem. There could be some kind of, supply issues there. But if there is a demand, the supply will follow. That's what we see. It may take a little time or a little while, but already now everybody knows of it. So everybody's making, getting ready for what can happen there. So and also when we hear, the prices, inflation rose because of the war, Russia's aggression war against Ukraine, it was really not the case. I mean, there was other reasons why we saw inflation going up at that time. So I think all these news, coming out, and it's just a part which just disturbs the picture. The real picture is looking at the structures, looking at what we see in terms of market developments, and how all of these markets play together, how forex and how commodities and how bonds and equities and so on. So what I have is I have a multidimensional market model where all of these markets and then interact. The levels and the levels that they need to reach, and the bottoms and so on, the tops that we've seen, needs to be in alignment. And this is what I've had, and that's why you start to see develop in one of them, and you need to all the rest of them to fall in place. So when you have a multi-dimensional system like that, I don't follow what happens one place. I mean, we saw some years back I think it was an attack on a Saudi Arabian oil facility or something like that, and everybody was saying, "Oh, this is now, and oil will go to, I think, 100 or 200 or whatever they started to say." And what you saw was the spike that day was actually the top of oil at that point. So we hear that all the time. But the fact is, there is a dynamic world out there. So when we hear these news, it's something that is being taken care of. There are people that actually sit and think, "Oh wow, if that actually happens, I need to, go around Africa." And I mean, there's other things also, but there will be things that are happening. These are not the things that drive the world. These are news. These are interesting things that we can understand. But in real life, the dollar is determined by 100 variables, not one or two. The oil, the same. And these are the interesting one. One day it may be the one or the two of them that are more interesting in terms of determining the price, and other days it'll be something else. But in the long run, we see structures developing, and the structure is telling me that there's no way out of a deflationary bust at this point here, and that means oil will come down. And that's the same thing I said a year ago when everybody was talking about inflation staying high for a long time. I said no, and I think again I stood alone there when I said inflation is not going to be permanent, and inflation is a spike and it's going to come down, and we're actually going to see deflation. Now we see at least true inflation say 1.44, and if I'm right on these numbers, that I think we're going to see negative inflation and outright deflation. Dollar will drop. Sorry, oil will drop a lot, and I see what we hear in the news and everywhere, and what happens around the world, as things that can potentially spike price for a certain amount of time, but it's not something that puts it in the direction or puts it, in a
mm,
new bull market for the next 5, 10 years. What happens there is that you see the whole structure of what happens, and what the economy, when it starts to grow again, and we start to see the consumers want to put on, debt again, and what else when we got out of this, then oil will do fantastically. And there'll be these kind of reasons. This about news events, I don't pay much attention to it, honestly.
mm. So it's kind of like, well, trying to filter out noise and ignore knee-jerk reactions, basically.
Yeah. Yeah.
Um, what and that might also be maybe a podcast in and of itself. Like, what's the difference between those two? Because you also the media has to write about something, and there's an endless number of interview channels and podcasts and blogs and whatnot that have to write about a new gold backed currency or the BRICS thing and type of thing. But when do you know it's real? Like, is the thing that I'm bringing up right now, like the BRICS type of thing, where they're forming an alliance that would eventually phase out the dollar. Is that something that would show up in the models that you use?
Well, in my model, it shows there's a I mean, there are certain levels that will be reached. There was a level that was reached in 2000 around for the dollar, which was the Dixie hitting 120, and then it came down after 2008, and then started to rise again. And to me, we have a rendezvous with that's 2000 level on the Dixie. And then there we have, different structures to how we get there, different paths, how would you get there? And that is actually sometimes what can, give us the news. Sometimes, I'm working with also with a hedge fund, and I will sit with them and say, I do not know what the narrative will be for this, but I think there will be a top in the dollar, which I said in September or October of last year, 2022, sorry. And I don't know why, but I think the dollar is going to come down again. And then you have something that comes out, and then people say, oh, that's the narrative. That's why. That's the trigger. But I live the other way around. I say the structures tells me that we are starting to see that the rally is getting tired in its tooth in terms of rising, the price is rising, and you start to see that the structure is hitting certain levels, and then say, well, this is the level where I think it will turn. And that means that if oil tops here and the dollar bottoms here, maybe that's and then you have calibrate that with hundreds of different charts, and that's why you get it's just not based on one thing. So whatever kind of narrative that comes out, well, then I sometimes just point to it and say, well, that's actually the thing that everybody will be talking about and saying this is the reason why we see the top or the bottom in certain things. So I don't know what the narrative will be when we see if we see the crash in the markets. Well, what will the narrative be? Will it be because we've seen war expand, or getting something breaking out somewhere? I hope not. I know what the narrative was around inflation, but that it was because of the war in Ukraine, which was incorrect. You can just sit down and just look at the charts and see that the inflation or the price rise in certain commodities started much earlier than that, and 90% of it was actually happening before the war broke out. So these are the narratives that we live in. This is the world of narratives. This is why, was it Mark Twain who said, if you read newspapers, you are misinformed, and if you don't, you are, you're not informed, or you're uninformed. Right? I mean, it's like this. We want to tie it up to something we as human beings can comprehend. But the thing is, the economic structures, the macroeconomy, is much more complex. And we cannot put it down to one or two things. It's not what Trump says or Biden says. It's not what happens just in the Red Sea, but it's nice to talk about because everybody can then talk about it and say, oh, yeah. By the way, the rise in oil price of 0.5% today was because of what happened in the Red Sea. And I say bullshit. It may have fallen because of that, because two or 20 others, suppliers were standing up and say, hey, what happens down there is actually interesting because then we can do this and that. And let's start to put our, money in play here. So it's too complex for that, but it's like the way the world needs to be told how the economy works. And it very often, as I see it, it's something that is explained like that, but it's very often the reason why we see the development we do.
Hmm. What do you then think is not noise or media, just a media story out there? Like what is this? What is a serious thing that you pay closer attention to outside of some of the big war happening in Europe, or what else?
Well, the things I would be paying attention to is things like the introduction of a central bank digital currency, because that would be a game changer to a certain degree. And that is something that is being worked on in the ECB and I think elsewhere also. So that is something that is important. We don't hear too much about that because that's probably too boring at this point. But that is interesting because that can become a potentially a new at least a competitor to a dollar or for the reserve currency status. That is important. The BRICS countries is also interesting, but I just don't think they can get their acts together and align that. And also, if the rest of the world will stand up against that, the Western world, I think we'll still outmatch them in terms of because the trade that is going on and so on. I know that they have in terms of the GDP and in terms of also commodities and all that. But I would like to see that work first. If they did that, if they really could come out and say, okay, we'll put, gold behind a currency here and we want to, stand behind one currency, but that's not what they want to do. They have individual things, but that's an important thing as well. What else is important? I think there are political things that are important in terms of how what we see with Europe, and if there is if you start to see people getting discontent with the whole setup, and because if they start to feel poor, or if they have, and I think also, of course, the U.S. presidency, or that's also important because you see at least the division between the U.S. Is important because that can have ramifications for the rest of the world and for the economy as well. So I think these are some of the things, but this about small things that happens in the on a daily basis, so to speak, will not have the importance that the media is trying to push them up to have. It's simply not correct.
Hmm. CBDC, central bank digital currencies. Interesting good or interesting bad?
Um, okay, you're putting me on the spot there. I think it's interesting. Good. I mean, I think in order to clean up the world, in order to clean up the mess we've done with unsound money, with the kind of levels of debt that we have around the world, we need to see new sound money coming in, be getting introduced again. We today we just have this. Yeah, you also said it yourself. You say, yeah, but we just pour 2 trillion on it. I mean, that you did not do when you had gold peg to you didn't just say, oh, let's just pour 2 trillion on it. So I think that is important, and I think that is what will come out of this central bank digital currency here. I think that is what will become the final result of it. That we'll probably see some kind of monetary reset at some point, where new basket of a reserve currency will be put together, and it will probably be gold backing it, and it will probably be something of a central bank kind of digital currency behind it also. And they will also talk about that because of trying to get rid of of the black economy, or not people not paying taxes and all that. They'll try to make sure that that's a way to do that. So I think this is one of the things that will put us on a new trajectory, into a growth trajectory into the next 10, 20 years, and also with the technologies coming up and so on. So yeah, I'm on the case of this is a good thing, because we need to clean it up, and I do not believe in the DeFi world or anything like that. The DeFi world thinks that the dollar will lose its currency, the reserve currency status, to Bitcoin or something else. I don't see that happen. I see the technology behind crypto, blockchain, will be of tremendous value for companies around the world. They just don't know about it yet, but it will, and that will be the trigger for the fourth industrial revolution. And the whole money side of the crypto will fade away when we have had the next crisis, as I see it.
Well, so but it basically it's gonna take a crisis to kick off the implementation of CBDCs, basically. So you don't expect that's something that happens over the next year, like that's something that's 5 year
No,
type of thing.
no.
Hmm.
They
Okay.
are they are working with it. It's under development, and I think it's something that will be introduced when they have to, and it needs to be, they have one shot at that. It needs to be a success, and it will be, kicked in immediately, because you can also ruin credibility if you do not make it a success. So it's something that will be planned carefully, and it will not just be introduced immediately, and it will not be introduced into a deflationary crisis. It'll be introduced into when inflation starts to take hold, and if you get a stagflationary crisis, then you will probably need something to do something more structural, not just throwing money at it, but actually getting something structural, which will be in terms of actually saying, okay, guys, we actually have a currency here that we cannot print, and there will be a certain increase and quantity increase of that for the next many years, and this is how we're going to develop it. That sound money system needs to get back in place before the economy and the economy can start to work again. The whole thing about blowing up the economy, not blowing up, not exploding it, but blowing it up like a bubble,
Hmm.
by infusing trillions and trillions of money, will work for some time, but it will not work, forever. And that's for forever. Yeah. So I think we will see that for a certain amount of time, and then we will see that we'll get a sound money system, monetary system again, and that is sorely needed, I would say.
Hmm. Yeah. Indefinitely. I hate that word too. It's an
Indefinitely.
annoying
Yeah, that
word.
was what I tried to say exactly. Thank you.
It's an annoying word,
It's
but it
getting late
sounds
here
nice.
Friday.
True. What Interesting take on CBDCs, definitely. Because you have sort of the right or the same thought behind it as a lot of the free money market guys that I have on free market guys that I have on here. But coming from a whole different angle, because a lot of them would say, "Oh, this is, it's the worst thing ever. I mean, it's the worst thing since cancer or whatever, digital currency, central bank digital currency." So definitely interesting take. Um, there is a market for those takes out there. We haven't talked a lot or any actually about some of the commodities that are less elastic, where demand is almost inelastic. Like uranium, for example. Do you remain bullish on those throughout whatever is about to happen?
Well, you're right. They are inelastic in terms of demand, and that's well, more inelastic. I would expect, and I think when you look at some of the companies, Cameco, I think is one of them, and I don't follow it so closely, but I do think that there will be, as I see technically, that there'll be new lows coming in some of those stocks. But uranium itself, well, we are in a world where energy is important, and we need to to produce that somehow. And so I'm not sure how that will work actually, but I could see in an economy that is where that's coming to a crash, that's going to crash. Will you will see less use of energy also, and that's why I think that the price of that could also come down. But again, you're saying correctly, it's not as elastic, and that means that you will see that it probably doesn't see the same kind of drop. So, but I don't follow that very closely, so I'm a little on thin ice here.
Yeah. Okay, no, fair point. That's also a broad topic. The energy transition. It is that something that you think is also sort of a real narrative, or is it one of the noises out there?
No, I think it's a real narrative, and it's happening. I live in Denmark. We we do a lot of that energy transition, and then on certain days we have the windmills are producing the whole 100% of our the electricity we need here. So that is definitely happening, and it should absolutely. We need to become wiser in how we produce energy, or how we produce electricity. So I think that is a real thing. Yeah, and I think it will um, increase in size and volume, but during a recession, I think it'll be forgotten for a little while, and I think that is what we can look into for a certain amount of years. But then after that, it will it is the thing that has come to stay, and it'll grow fast also in the next 10 years.
All
Yeah,
right. Well, yeah. Thank you so much for being here. It's Henrik Zeberg, and that's not Henry. Henrik Zeberg on Twitter,
yes,
that is, or
exactly,
thezebergreport.com. I'm going to put the link in the
exactly.
description as well for
Sounds fantastic.
if
Thanks.
you're interested. So, yeah. Thank you so much for doing this.